Hello everyone, this is Moniza. Today we are going to have a discussion regarding IAS 1, that is International Accounting Standard Number 1, Presentation of Financial Statements. Before we carry on our discussion regarding IAS 1, Presentation of Financial Statements, it's better to know that what are the financial statements and why do we need to prepare them. So basically, financial statements are the formal records of the financial activities and the position of a business. And why do we need to prepare financial statements? These are needed to be generated in order to supply the financial information to all of the stakeholders of an organization so that they can get an appropriate support while making any economic decisions. For those who are not familiar with the term stakeholders, let me elaborate this term for them. Stakeholders are all those persons or parties which can affect or can be affected by the activities of the business. So why do we need to produce financial statements? These are needed to be generated in order to supply the financial information to all of the stakeholders or the users of an organization so that they can get an appropriate support or appropriate information while making any of the economic decisions. Now, let us have a discussion regarding IAS 1, Presentation of the Financial Statements. International Accounting Standard Number 1, that is Presentation of the Financial Statements, it is applicable to all of the reporting entities. It sets out the overall requirements regarding the preparation of the financial statements. It also gives us the guidelines regarding the structure and format of the financial statements. IAS 1 tells us about the purpose of the financial statements. According to IAS 1 Presentation of the Financial Statements, the purpose of the financial statements is to provide the information regarding financial position, financial performance, and cash flows of the reporting entity. And in order to fulfill this purpose of making financial statements, IAS 1 lists the complete set of guidelines about what should be included in the financial statements. Statement of financial position. The other name for statement of financial position is balance sheet as well. Statement of comprehensive income. Statement of changes in equity. Statement of cash flows, and notes to the financial statements are produced by the entities in order to fulfill the basic guidelines of IAS 1, Presentation of the Financial Statements. IAS 1 explains the general features or characteristics of the financial statements as well. The general features or the characteristics which should be kept in our minds while preparation of the financial statements are given. Number 1 is fair presentation and compliance. All of the financial statements which are being prepared, they should be providing a true and fair view of the actual financial performance and position of the company. Whatever is actually happening in the company should be fairly presented in the financial statements. And all of the information which we are going to include in our financial statements should be complying with all of the applicable reporting standards in all material respects. This is the first general feature of the financial statements given to us by IAS 1. Then IAS 1 tells us that the financial statements should be having a feature of going concern, which means that the company should be able to continue as a going concern in the foreseeable future, at least for 12 months. And if not, this situation must be reflected by the financial statements. Then accrual basis. All the financial transactions must be recorded as per their occurrence, not according to the cash flow. Whenever we will be recording the financial transactions in our books of accounts, in our financial statements, they should be having a feature of accrual basis of accounting. They should be recorded as per their occurrence, not according to the cash inflow and outflow from the organization. Then point number 4, materiality and aggregation. Each material item shall be presented separately, and immaterial amounts shall be aggregated with the items of the similar nature and function and not presented separately. And what are the material items? Material items are all those items, if they could individually or collectively influence the economic decisions of the users taken from the financial statements. So every item which is material should be presented separately in our financial statements. And immaterial amounts shall be aggregated with the items of the similar nature and function and not presented separately according to IAS 1 presentation of the financial statements. Then come to the point number 5, offsetting. Assets and liabilities shall not be offset. We cannot offset any of the assets and liabilities with each other, except when it is required or permitted by the other international accounting standards or international financial reporting standards allows us to do so. Other than that, we are not allowed by IAS 1 to offset any of the assets and liabilities. Point number 6, frequency of reporting. Full set of the financial statements, including statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, and notes to the financial statements. This is full set of financial statements. This shall be produced at least annually. On the annual basis, we need to report, we need to produce the set of financial statements according to IAS 1. Then point number 7, comparative information or comparatives. Comparative information from the previous periods shall be disclosed for all items of the financial statements and also in the narratives where relevant. So whenever we have to prepare our financial statements, a comparative information from the previous years shall be presented accordingly. Then consistency. We need to prepare our financial statements on the consistent basis, which means that all of the information which we are including in our financial statements must be presented in the same way as presented in the previous periods. IAS 1 presentation of the financial statements does provide us an information about how financial statements look. Each component of the financial statements must be clearly identified. Then it is this is the requirement provided to us by IAS 1, that the name of the reporting entity should be given. Then the name of the financial statement which we are preparing should be given. Then the date of the end of reporting period for which the financial statements are prepared should also be given. Then the information about the presentation currency and the level of rounding shall also be expressed. Keep this thing in your mind that IAS 1 does not prescribe the format of the financial statements. I repeat, IAS 1 does not prescribe the format of the financial statements. And according to the convenience of the companies or the reporting entities, they can follow the method of presentation. If we individually look at the individual components of the financial statements, statement of financial position, IAS 1 requires the line items to be presented separately in current and non-current distinction. If the company is holding non-current assets and current assets, they should be distinguished as per the requirements of the IAS 1. Normally, we do see the given line items in our statement of financial position according to IAS 1. Number 1, for example, property, plant, and equipment, which is covered under International Accounting Standard number 16, which we will be discussing in our later lectures. Then intangible assets covered by IAS 38. Investments in associates covered by IAS 28 and IFRS 11. Then deferred income tax assets covered by IAS 12. If we do have a look on the current assets, normally the current assets which we can see in our statement of financial position are inventories, which are covered by IAS 2. Then trade and other receivables, financial instruments of the business, these are covered under IAS 32 and IFRS 9. Basically, IAS 39 is replaced by IFRS 9. Then current income tax assets, which is covered by IAS 12, and cash equivalents, which we do cover in our separate financial statements also, which is IAS 7. And on the other hand, as being the financial instrument, we do cover cash and cash equivalents in our IAS 32 and IFRS 9 as well. So as I've told you people that IAS 1 does not prescribe the format for the financial statements, but these are the normal line items which we do see and which we do need to present in our financial statements normally. Now come to the other part of the statement of financial position, which is equity and liabilities. Under the head of equity, we do need to present the ordinary shares, then retained earnings, other components of the equity, and non-controlling interest, which we will be covering later in our lectures under IFRS 3. Then liabilities, which have to be distinguished between non-current liabilities and current liabilities. And this is the requirement of IAS 1, as I've told you earlier as well. Under non-current liabilities, we do need to mention any of the borrowings, non-current borrowings, long-term borrowings of the business. Then deferred income tax liabilities, IAS 12. Under current liabilities, we have to mention our trade and other payables. Current income tax liabilities, which is covered by IAS 12. So this is a basic format which can be adopted by different reporting entities. But IAS 1 does not prescribe any particular format for the presentation of the financial statements. Then come to the second important financial statements, which is statement of comprehensive income. Statement of comprehensive income is divided into two major components. That is statement of profit or loss and other comprehensive income. Reporting entity may choose to present the comprehensive income in two different statements or in one statement. It is according to the choice of the reporting entity. Either they can present the comprehensive income in two different statements or in one statement. Under other comprehensive income, companies need to present each component of other comprehensive income by nature and share of other comprehensive income by associates or joint ventures by equity method, and total comprehensive income. Both profit or loss and total comprehensive income shall be reported in allocation attributable to the owners of the parent and NCI, which we will be covering in detail in IFRS 3 business combinations. We will be having a detailed look upon the concepts related to the parent company and non-controlling interest. Up till here, you just need to be clarified that both profit or loss and total comprehensive income shall be reported in allocation attributable to the owners of the parent and non-controlling interests. So generally, the line items which we do need to present in our statement of comprehensive income are revenue, which is generally the first line item in our statement of comprehensive income, SOCI. Cost of goods sold. Then we do deduct cost of goods sold from revenue. We do get a figure of gross profit. Then after deducting operating expenses from our GP, gross profit, we do get a figure of operating profit. Then after deducting interest expense, we do get a figure of profit before tax. And then we do need to deduct an amount of income tax expense covered by IAS 12 in order to get the figure of profit for the year. Profit for the year and other comprehensive income has to be added and then distributed among parent and non-controlling interest. What are the basis of distribution, allocation, and attribution of the profit among parent and non-controlling interest will be discussed later. Then the third important financial statement is statement of changes in equity. This is the basic format provided which we can follow for the preparation of statement of changes in equity. IAS 1 requires that total comprehensive income, which is derived from the statement of profit or loss, which is the previous financial statements we have discussed. Total comprehensive income derived from SOPL, separately attributable to the owners of the parent and NCI, must be presented in our statement of changes in equity. Then for each component of equity separately, effect of retrospective application or restatement recognized according to IAS 8. And also for each component of equity separately, reconciliation between carrying amounts at the beginning and at the end of the reporting period. Also, changes due to the profit or loss, other comprehensive income, and owners. For example, if owners have invested some capital in the business, all of these things should have to be presented in our statement of changes in equity. Then IAS 1 presentation of the financial statements provides us the guidelines about notes to the financial statements as well. Notes to the financial statements provides us the basis of the preparation of the financial statements. With general policies we have adopted in order to prepare our financial statements shall be discussed in notes to the financial statements. The notes to the financial statements must include information which is relevant and necessary to be included in order to understand the financial statements. So all of the general policies which has provided the basis for the preparation of the financial statements should be discussed in the notes to the financial statements. Then how the international financial reporting standards have been followed for the preparation of the financial statements should also be discussed. then accounting policies and judgments being used for the preparation of the financial statements should be discussed in the notes to the financial statements, because this will be helping the users of the financial statements to know the basis on which the financial statements have been prepared. The amount of capital introduced by the shareholders, owners of the business, should be given in the notes to the financial statements, should be disclosed in the notes to the financial statements. Then all of the kind of the dividend, interim or the final dividend, should be disclosed in the notes to the financial statements. And any other disclosures which are relevant and are required by the other international accounting standards should also be given in the notes to the financial statements according to IAS 1 presentation of the financial statements. So my dear students, this is all for today. We have successfully completed the discussion regarding IAS 1 presentation of the financial statements. If you do have any other questions regarding IAS 1, you are most welcome to ask. Thank you so much.